Okay, so today our discussion is about IFRS 9, International Financial Reporting Standard 9, which is about financial instruments. As you can see, the name of this standard, financial instruments. Everybody know about financials, what is finance, what is financial management, what is financial accounting, and instrument. um, First of all, when you listen about instruments, so would have think that you would have thought that we are talking about the T-bills, we are talking about the debentures, we are talking about all the other financial papers. But now I would explain and you would understand better after watching this video. IFRS 9 specifies how an entity should classify and measure financial assets, as it is very clear from the first sentence that IFRS 9 financial instruments specify how an entity should how an entity should classify and measure financial assets. An entity have a lot of company. An entity is also called company. A lot of financial assets like cash at bank, cash equivalents. So how they classify and how they measure their financial assets. Actually, financial liabilities, how they measure, how they classify financial liabilities. And some contracts to buy or sell non-financial items. IFRS 9 requires an entity to recognize a financial assets or financial liability. IFRS 9 requires an entity to recognize. To we in common language we say that you have to record the entry, but this word is replaced by recognize. Record is replaced by recognize in accounting language. You have to recognize the entries. So IFRS 9 requires an entity to recognize a financial asset or financial liability and a statement of financial position where it becomes party to the contractual provision of the instrument. At the initial recognition, you have to keep in mind, this is very important point, that assets and expenses have both two types of recognition: initial recognitions and subsequent recognition. But uh, opposite to this, incomes and liabilities have just only initial recognition. We cannot subsequently recognize the liabilities. Okay, an entity measures financial asset or financial liability at its fair value plus or minus. In the case of financial asset or financial liability not at fair value through profit or loss, transaction costs are directly attributable to the acquisition of or issue of the financial asset or financial liability. What is financial assets? When an entity first recognizes a financial asset, it classifies it based on the entity's business model for managing the asset, and the asset's contractual cash flow characteristic is follows. Amortized cost. Everybody know about the amortization and depreciation. The tangible assets can be depreciated with the passage of time. They have a useful life. And amortization cost. Amortization we do of intangible assets. Intangible assets can be amortized like a software, like any other intangible assets your business model have. So this can be amortized with the passage of time. A financial asset is measured at amortized cost if both of the following conditions are met. The conditions are given below. Two conditions: the asset is held within a business model whose objective is to hold asset in order to collect contractual cash flows, and the asset is held within the business. The business is using the asset for, in a simple words, you can use creation of money, cash flows, collect contractual cash flows. So this is the ownership of the business. Number second, the contractual terms of the financial assets give rise on specified dates to cash flows that are solely payments of the principal and interest on the principal amount outstanding. Alright. Fair value through other comprehensive income financial assets are classified and measured at fair value through other comprehensive income if they are held in a business model whose objective is achieved by both collecting contractual cash flows and selling financial assets. Fair value through profit or loss, any financial assets that are not held in the one of the two business models mentioned are measured at fair value through profit or loss. When and only when an entity changes its business model for managing financial assets, it must reclassify all affected financial assets. So this standard is all about financial assets and financial liabilities. The business model of any go business business keep that. So this is not very much difficult, very simple, but for understanding this very well you need to know the basics of accounting, some of the standards of accounting, some of the rules of the accounting and finance. Then this is not going to be very difficult for you. So thank you for watching and wait for next video. Any question you can ask in comment section, I will answer. Thank you very much.